up, and how should you be looking at the markets as of now? So let's get on board Sushant Bhansali, CEO of Ambit Asset Management, who's joining us to give us some color on how to play this market. Hi, Sushant. Good afternoon to you. Thank you so much for taking the time out and joining us.
Thank you for having me here.
Sushant, let's talk about how really the market, especially the broader end of the market, the large caps are shaping up. They are stuck largely in a range, but the SMIDs are really the outperformers, and perhaps that could be attributed to the fact that the earnings growth has been better, and therefore the outperformance or the rally that we're seeing in the SMIDs. But SMIDs also were trading at a premium valuation despite the correction that we saw. So do you see more legs to this rally as far as the small and mid caps are concerned? And clearly this is a stock pickers market, so within that, within the small and the mid caps, what are the pockets of value that you see?
Too long a question, but I'll try and answer all of them. Definitely mid and small cap rally has been much better than large caps, but then that how the fall was also in the first quarter of this calendar year. So I think we saw January, February deep corrections in mid and small caps. Primarily large caps were less, I would say, in the correction mode, and that's why the reverse has been on the similar lines. And once something drops, then a significant uptick. Still, I would say that as of about a week, till about a week back, almost 73% stocks were still lower than where they were in September when the Nifty peaked out last time. So between this going down and coming up, most of the stocks are still negative as such. And if you look at that phase, January, February, almost 90% of stocks were having negative returns, while March, April, May, 90% stocks were up as well. But the sum total was that over this period, 73% stocks were still down. If you look at the valuations currently, Nifty, if you look at the current expectations are now almost around high single digit growth compared to almost mid-teens sort of growth till about a year back for FY26. So expectations of the market from large caps have significantly come down, almost by 25-30% growth has come down. And that will result into market looking not that cheap as they were, I would say, from a large cap perspective in September when markets peaked out. From there, the markets have slightly become expensive, and it's more because of the dip in the growth outlook for Nifty. If you look at mid caps, the growth rates are still very appealing, although the small cap growth rates have also come down compared to a year back, how we are thinking about FY26. So from here on, definitely it's a stock pickers market. We have seen a big bull rally for the last 4 years. Primarily because of huge earning growth across sectors, across market cap segments, but that is narrowing down. The sales growth, if you look at on a quarterly basis, is only dipping for the last 10, 11 quarters, and similarly EBITDA and PAT growth as well. Having said that, there are a few pockets where the sales growth is coming back as well as earning growth is coming back, and those are the pockets where investors should focus on. The other big trend, I would say, from the next year or so perspective will be to look at companies who have historically delivered quite well, and they are currently expected to deliver as well. So narratives will be behind and numbers will be more in focus for the next few quarters from investors' perspective.
All right. Hi, Sushant. Good afternoon. This is Shrishti joining in. But since you have been saying that it will be a stock pickers market and should focus on some of the pockets where earnings will drive the momentum going forward, give us some sense, because we just got done with the Q4 earnings season. Which are the pockets that are looking interesting to you and where investors should focus on?
Sure. So Q4, if you summarize the results were mostly in line. But the expectations before the results actually had come down drastically. So if you look at on an objective basis, the numbers are not that great. I think Nifty earnings were about 3% and BSE 500 was just about 10% year-on-year growth this year in this quarter. but the expectations were, I think, quite weak. So most of the companies, almost, I think, just a quarter of companies didn't meet the expectations. If you look at Bloomberg consensus, and majority of companies either were in line or were ahead of expectations. But the expectations were quite muted. Going forward, as we seek, I think there are a few sectors where the expectations are a bit better than other sectors. And financials are, I would say, a top pick from a sector perspective. Given the interest rate regime now on the downward trend, there are opportunities for lenders who have had a large share of fixed rate loans to make more money in the next 1 or 2 years. So that will be definitely a great sector from an earning growth perspective. Then telecom continues to do quite well. I think last few quarters they have done well, and the sector is highly consolidated. So there again, it will be good earning. The another one I would say from next 2 or 3 quarters perspective is chemicals and especially agrochemicals. Uh, uh, the stock situation globally has been, I would say, at decadal low levels. So there should be refilling of inventory. So agrochemicals and even I think chemicals in this quarter has surprised in terms of how profitability has come back. That also is because of the base effect, but nonetheless, chemical companies have made a good comeback. And agrochemicals is another pocket I would say we are quite bullish on. Uh, the sectors which can probably surprise us will be FMCG and consumer discretionary, where a little pickup in demand because of the tax breaks and because of the low interest rate regime, the demand might come back, and those are the sectors where expectations are not that great currently, but can surprise investors.
Right. Sushant, give us some color on the agrochemical space, like you mentioned, because there's still certain problems that persist. Are there certain geographies that certain companies cater to that are particularly on your radar?
No, globally, if you look at the stock situation globally is at decadal low. Uh, the inventory levels at each of global innovators is quite low, and they will be refilling a lot in the coming months. The I would say the announcements from global agro majors are quite positive recently as well, and that indicates the similar trend. Also, the weather outlook is not bad for the coming few months, and that should result in good amount of acreage and sowing, and that's why agrochemicals I think should do quite well.
All right. So that's about the chemical space. But Sushant, I was just reading a very interesting report of yours on the disruptors, where you have touched upon the quick commerce space, EV, and how the lab grown diamonds have been doing well. But specifically on the quick commerce side, Sushant, because now after so many players emerging and the kind of price war that they have been happening, we now know that which players will stay in the market. Given their financial background as well. But from here on, Sushant, how are the valuations stacking up? How comforting are they at this given point? Because some of these stocks within the listed place, they have also corrected sharply from their highs. So by when do you see those levels coming back, and how are the valuations supporting the numbers right now?
Yeah. So in this sector, still more narrative than numbers, but you have to have a long-term view and see whether the narrative is consistent and numbers are getting delivered towards that narrative or not. So what we have seen in the leading players that numbers are getting delivered. Of course, there are new areas of investment which the companies have got into, which is more quick commerce, moving from food delivery, and thereby there is on a financial year or quarterly basis, the numbers are looking bad overall. But if you deep dive into the numbers, you look at that food delivery numbers are doing well, while quick commerce numbers are creating a drag. But that's because of increased investments and trying to reach out to more places sooner than later and quicker than other players and competition. Because in this sector, winner takes all. And if you are the first player to consolidate in a in the micro market, then you are always in the lead, and that's the trend historically we have seen. So from here on, valuations are anybody's guess in terms of whether they are justified or not. But if you believe in the long-term potential of few of these players and believe that their execution is better than others, then the sector is quite large, and the TAM has actually gone manifold for few of these companies in the last 2-3 years, and that provides a big opportunity for some of these players to have, I would say, be amongst the top 15-20 companies in terms of profitability in the next few years in the country. So that's the potential of that sector.
Sushant, point taken, and thank you so much for taking the time out and weighing in on the markets and giving your select bullish themes. But
if you like this video, then like, share and subscribe to ET Now.